Welcome to Nasdaq Trade Talks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, a regulatory landscape, and capital markets. I'm your host, Jill Malandrino, and joining me this afternoon is Kevin Davitt, head of index options content at Nasdaq, and Joe Mazzola, head trading and derivatives strategist at Charles Schwab. We're here to discuss retail trader options flow and the increasing use of index options. It is great to have the both of you with us. Welcome back to Trade Talks. And Joe, I always find it great to get your insight because you have such a good view into how retail traders are approaching the market. Any high-level trends that you can discern that could be helpful for us?
Yeah, Joe. Hey, how you doing? Thanks for having me. What I find interesting is, coming out of the sell-off we had at the beginning of August, we saw decent buying in terms of equities as a whole. That tended to kind of fade out a little bit towards the end of the month, and then a little bit more rotation into fixed income. But what was interesting on the options side is a lot of that single stock equity call buying that was really prevalent in the spring and early summer, really before we kind of got that rotation trade in July. It didn't come in to the same extent that maybe I was expecting. I was expecting, people would be looking for those opportunities on some of those beaten up names, specifically some of the mega cap tech. And we did see some, of course, we did see some buying, but not to the level that we saw before. And to me, that it just kind of signals that maybe investors are a little bit hesitant to kind of load up the boat on some of those upside calls. And what that could mean, right, is that maybe we don't get that upward thrust even at this breakout that we've seen right now. I mean, look, the breakout that we've seen has really kind of been across the board. And tech, yesterday participated, but for the most part, it has lagged a little bit. And that might be a continuing story until we start seeing more of those upside call buyers step in.
Yeah. And do you think, Kevin, that perhaps it was a function going into the interest rate cut that was expected, but we just didn't know how much? How did the options market react to that? Perhaps, options traders weren't taking on, as many positions because there was uncertainty around that.
So I believe it's fairly typical to see flows move toward the index level, whether it's ETF options or index options, ahead of big macro events. That's kind of been the backdrop for the past couple of years. You can express an overall outlook using these tools, and we observe tons of Schwab clients actively trading index products. I think they're drawn to the features that set index products apart from ETF and single stocks, like Joe was talking about. The cash settlement matters for those that are just looking to manage options exposure and not necessarily underlying stock exposure. They tend to favor index products. And we've talked about this before on your show, but just as a refresher, beyond that, you don't have to trade out of a position ahead of expiration, like a day like today. It's less babysitting because of that cash settlement. You could be out on the golf course. And one other thing worth noting on a day like today, where SPY, for example, trades ex dividend, is that index options are European styled and can't be exercised early, whereas index options cannot be exercised early. So you could get assigned on an ETF option. I think we will likely see a continued emphasis on the big picture here as we move into things like the next non-farm payroll and certainly the election.
Yeah. And Joe, are you continuing to see retail traders employ options? It seems to be, it's been on an uptick trend.
Oh, absolutely. I mean, 50 million contracts a month. Not here specifically at Schwab, that would be nice, but across the board. What we have found, and I think this speaks to Kevin's point a little bit, is that with the index options, people are starting to gravitate towards the shorter term expirations. They like the idea of not having to hold positions for a month at an end, especially given some of the risk that we've seen recently, whether that is kind of global macro risk or just single stock risk as a whole. And if you have the ability to trade weekly or even daily options to a certain extent, you're starting to see more and more investors and more traders are starting to gravitate towards that. They don't want to deal with the time decay. They like the fact that it's a binary event. They're either right or they're wrong, and they figure that out fairly quickly.
Yeah. And Kevin, that lends to your point, and we talk about this monthly when you're on the show, the increasing use of index options, whether it's advisors or retail traders. But let's take a step back for a moment here. Any observations from Q3 when you think about the volatility picture overall?
Yeah, I'd be happy to talk about that. And you could pull up the visual that you flashed a little bit earlier. So Q3 will obviously wrap up in another week. And I think it's worth pointing out how differently the markets behaved over these past 3 months compared to the first half of the year, at least from my perspective. There's a whole bunch of ways that you could parse this data. VIX tends to get the most attention. I help support NDX growth, and I want people to know that VXN applies that VIX methodology and uses NDX options as the input as opposed to the S&Ps. So just to illustrate that from a high level volatility measure standpoint, Q1 average for VXN, 17.65. Very similar in Q2, 17.75. The past 3 months or almost 3 months, VXN has averaged 21.85. That is significantly higher than the forward volatility measures we saw in the first 6 months of the year. Now, on average this quarter, the close over close move for the Nasdaq 100 has been plus or minus nearly 1.2%. And I would highlight, and did on the visual, the past 2 unemployment reports led to 2 of the bigger sell-offs during the quarter. And so I keep in mind that, like, for example, the day before, or the trading day before August 5th was a non-farm payroll number. And volatility tends to catalyze volume, like Joe mentioned around that August report. July index options volumes were very strong. They dropped slightly following that sort of really big shakeout, and they've been climbing since. I don't know if this mirrors what Joe has observed across the broader options landscape. Perhaps that's the case.
Yeah. And well, Joe, let's talk about that, what you have observed across the broader options landscape. And then also when you think about going into Q4, and of course, we have the US national election, so that does, throw another variable in there. But what are your expectations? Is there a way that it typically reacts? We know November, December, it's the holidays, tends to be a little bit momentum in the market.
Sure. So let's go back to the volatility that we experienced in July and August. And I think it's important to note that when you look at the S&P 500, to quote the S&P 500 very quickly, but we had 360 consecutive days without a 2% drawdown. And then between July and through the end of August, we had 4 days where we had a 2% drawdown. So, that alone kind of speaks to the volatility that we saw just within that short period. And, I think it kind of goes back to the idea of investors got a little bit spooked, got a little bit shaken out. They did continue to trade, but some of those kind of short volatility products took a bit of a step back from, and that makes sense when you see those type of moves. And I know Kevin kind of quoted what we've seen in the Nasdaq in terms of the realized move, and I think that's another important point. We always talk about implied volatility, but realized volatility really stepped up dramatically in the last couple months to the point to where the spread between the two almost got inverted. Basically, the move justified what you're paying for the implied volatility. Now, do I see that going forward in Q4? Potentially. And here's why I say potentially. You talked about some of the macro factors, the election being first and foremost. If you still look at kind of the VIX curve out in October and November, it's still elevated. It has come in a little bit, but it's still elevated to the point to where maybe investors aren't saying that, they're worried that we're going to have a 2 or 3 week recount. But there is at least some volatility around what the election could bring to the markets. There's a lot of things that could play out. And I think a lot of times we get fixated on who's sitting in the executive branch, but it's really more the legislative branch that can move these markets. And I think if things line up and you get a bit of a stalemate, then volatility comes down quite a bit. But boy, if that's not the case, and maybe we're all red or all blue, you probably could see some volatility continue.
Yeah, I would agree with you there. But you know what, Joe, it's so amazing to me, the move from August 5th, the reversal that we saw when the market sold off, just this week with the 50 basis point rate cut, and how it recovered dramatically the following day. I feel like these trends, it's almost daily or intra-session versus, it would take days, weeks, perhaps months for that type of reversal to occur. I think that, the velocity of the moves is really what's interesting here. Kevin, give us a visual representation when you think about Q4 and seasonality.
Sure. So Joe brought up a bunch of very salient points. I think I could put a couple numbers around that, and then we'll talk about the term structure of volatility and what that might be implying. So just thinking about the past couple of weeks and the velocity of moves, I look at weekly at the money straddles and indexes, and for the past 3 weeks, the options have consistently underpriced, which again, Joe hinted at, the realized volatility. On average, again, looking back just the month of September, weekly realized moves have been 4.9% relative to the previous Friday close. Now, if I look out 1 week from now, the market continues to price in the Nasdaq 100 an up-down range of about 1.9%. The options seem to be convinced that realized volatility is going to come down. Now, if we look at that term structure of volatility visual, I think that the overall trend in Q4 tends to be positive for equity investors. You sort of relayed that Santa Claus rally belief. I think the focus will be to a certain extent on the election, but more front of mind near term will be earnings growth given valuations. And I think monetary policy is going to remain front of mind like it has for the better part of the past couple of years. This visual plots the term structure for NDX volatility over the next couple of months. It incorporates the election. I get this from Spot Gamma. It takes your at the money NDX volatility for every options expiration. It goes out to late November. You see that next week, the far left-hand side is relatively low, but most of the curve is flat with forward vol priced around 20%. Now, I would point out that 20% is essentially where 3-month realized vols are running in the NASDAQ 100. So no real premium, no real discount based on that sort of 90 calendar day window. You look out further, there's a slight election premium, but nothing wild. The markets right now seem to be pricing business as usual until like further review.
Yeah, right. And to Joe's point, it depends if we're, all red or all blue. And Joe, to wrap up here, do you think does the proliferation of products that are available to options traders, has that impacted the structure of the derivatives market at all?
No, absolutely. I mean, look, what was the prevailing trade for probably the last year and a half was the kind of the short gamma, short vol trade. And whether we talk about that in terms of kind of weekly or daily options, the zero DTEs, or whether we talk about that in terms of, some of the ETFs that have the overlay strategies, that was something that investors were using, for their benefit as a way to generate some income. But when you get that squeeze, right, when you get that vol squeeze and the realized vol, basically lines up or does, or if not surpasses the implied vol, then selling those products or participating in those products that sell the vol don't do nearly as well, right? You don't get that vol capture that you predominantly would in a normal kind of volatility regime, and it makes it harder. It kind of reminds me of being back in the late 90s, early 2000s. When I kind of learned the business, we were long volatility all the time because the move always justified paying for those premiums. We just have to, kind of scalp in and out. But, for 20 years after that, it was really just a kind of short vol. And then you'd had some opportunities in 2008 and then 2011 where you saw that expansion where realized was greater than implied. But, who knows? Are we moving back towards that for the rest of the year? Time will tell. I think that, Kevin made the point that if once you kind of get past that election premium, it does start to dissipate or at least flatten out a little bit. And maybe you get back towards a more normalized vol regime. But as of right now, owning straddles has kind of been the way to go.
Yeah, well, it'll be interesting to see when we reconvene in October for expiration. Appreciate both of your insights. Thanks for joining us on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.